Good afternoon. My name is Martin A. Smith. I'm the president at WealthCare Financial Group Incorporated. WealthCare is a wealth management, retirement planning, and investment advisory firm. I want to speak with you today about what's going on in the market and the economy. Now, if you've been watching the news, especially CNBC or Bloomberg, you've noticed that the Dow is down over 1,000 points today at its lowest point. Right now, it retracted somewhat back to about negative 700 plus points. And so this may be very unsettling for those of you who saved in your 401k for many years or your IRA, and perhaps personal finance and investment management is just not your thing, but you are diligent and saving. Perhaps you even have a financial advisor and someone that you trust, but you're still wondering why your portfolio is negative. And really what the impact of the economy and the market is going to be on your portfolio, and more importantly, on the security of your retirement. And that is also for those of you who are nearing retirement or already retired. What I want to do is just take a moment to explain what's going on in our economy, what's really happening in the markets, and give you my outlook for, I believe, where we're headed. Now, I did this same video for our clients in October of 2021 entitled Combating Inflation and Rising Interest Rates. And then we were just looking ahead at where we are today, actually, but back in October. And I'm going to show some of the graphics that I shared in my previous video. Our purpose back in October was to help our clients reallocate their portfolios. As an investment advisor, I build model portfolios and optimize them according to where I see the economy headed. And therefore, we try to get ahead of times like today when the Dow is down 1,000 points. And so the purpose, therefore, is to really demonstrate that when we're managing people's money, we're really looking at economic cycles. We're looking at indicators and headwinds and things that are really going to impact the markets. And that's really important, because if you just manage money based on the market being up or down a day with really no strong economic headwind or something that's really indicating what's going on in the economy, if it's just an up or down day, then that's sort of whimsical. And what we want to do is really optimize client portfolios according to where we see the economy headed. And that's what we do here at our firm, WealthCare Financial Group Incorporated. It's a process and a discipline that I've been committed to since I've gotten this business about 25 plus years ago, originally with my firm, my previous firm, A.G. Edwards and Sons. And I launched WealthCare Financial Group as an independent firm some years later. So without further delay, let me show you an economic chart here that will give you some insight into what's happening. I'm going to share my screen. So this is a dashboard of the Fed cycle. And I'm going to just broaden it a little bit for you. All right, so what you see here, the first thing I want to point out is this is a risk gauge, okay? Low risk, very high risk, and this is actually as of last August. And we're right around here. So we were looking at this, late last summer, and just really working to get ahead of where the markets are today, that far back, okay? So this is the extreme on the risk gauge. This is low risk, and you can see we're pretty much on the extreme. And the headwinds that I mentioned are as follows: changes in monetary policy, liquidity velocity, credit risk, and equity market risk. By the way, let's back up real quick. So the legend here shows you the current levels, and that's what these little dots represent. And then the current momentum to give you a sense of whether we are at the extreme end or the opposite end of this dot on each of these parameters. And then this blue octagon is Fed target equilibrium that delivers maximum employment, stable prices, moderate long-term interest rates, and financial market stability. So that's really where we want to be right here, Fed target equilibrium. And that means that if we are at the extreme end of monetary policy and fiscal policy, meaning that credit is interest rates are very low as it is, then we want to pull back to this point here. And by pulling back here, that means that equity market risk will pull back, credit risk will pull back, And then liquidity velocity will go from ample to about the medium. But that's not the case. We are at the extreme end on the changes in monetary policy and the Fed cycle policy with rates being as low as they've been for so long. Now, of course, we're going to start seeing some rate increases pretty soon here. But as a result of that, we are also at the extreme end where cash is very ample. And then, of course, credit risk is quite expensive, and it's apparent. And of course, that creates equity market risk. And this really is a recipe for higher inflation. That, coupled with the supply chain backlogs that we've seen over the last 6 months or so. And then there are two other major outliers, actually three, that may come to fruition in 2022. Russia has been taunting and tempting and is on the gauge of potentially, on the verge of potentially maybe invading Ukraine. Hopefully not, but it looks like they may try something there. China has been chomping at the bit towards Taiwan. And then we have the midterm elections coming up in 2020. So how is all that going to impact all of this? How are all those headwinds going to really impact our market and our economy if those things come to fruition while we're still wrestling with this scenario right here? Okay, and so you see the Dow is down 1,000 points at its lowest point today, and that's primarily based on the news of the Federal Reserve, and they're sort of switching gears. They're going to raise rates, but they're probably going to be a little more aggressive than people might have anticipated. And the market doesn't like uncertainty. The market likes to price in as much information as possible. And so if you ask me, I think rates should probably be more aggressive in the increase by the Fed, because if you don't, then the market will run a little bit, but then you're going to have higher inflation. And then you have to raise rates quite a bit in the future to bring that inflation back. And so we want to get to equilibrium. We want to get right about here. And this is also known as austerity, or stated another way, too much like right. But when we go back to this point, that means we've got to give up some of the gains that we've been enjoying in the market. But you got to think about the impact of, if we don't go back to equilibrium, it could be more devastating on our economy and our markets in the future. Now, if the Fed chairman, who is really the Trump-appointed chairman, Chairman Powell, if he was going to take a very sort of a easy tone, if you will, on interest rates and not be as aggressive and probably raise them 25 basis points and so forth, and that isn't going to help us long term. The market might celebrate it in the short term, but inflation will probably run higher. And then, of course, inflation eventually gets to such a point where you've got to be more aggressive and consistently so in raising rates in order to bring down inflation. And that normally triggers a recession. So I would applaud the Fed chairman's action and what we anticipate, at least some of the signaling that we're hearing from the Federal Reserve about rates going up. And yes, the Dow is down 1,000 points, but you don't have to, kind of stay in the same investment portfolio that you have been in. If you have the insight that I like to say we offer, and you have an advisor who's thinking about the impact of the economy on investments, then hopefully your advisor, like we've done, will be making changes or have made changes months ahead of what's happening right now in the market. That's really important. The economy drives the market, and we want to look at economic cycles and build and optimize a portfolio by asset class diversification in order to achieve the optimum allocation that is suitable for your risk tolerance. And that's what we do here at WealthCare Financial Group Incorporated, day in and day out. So if you have any questions, if you want to receive a second opinion regarding the management and performance of your portfolio, if you just want to have a conversation about the economy further and pick my brain about on my thoughts about the market and so forth, feel free to give me a call. You'll see our numbers below, including my email address, and we're here to help. If you're working with an advisor, and again, if you want to just have us take a look at your portfolio and build a apples to apples comparison of what our model portfolio based on your risk tolerance will look like and customize one for you, then more than happy to do so. We'll do it complimentary. And our objective is threefold. One, we want to reduce your risk. Two, we want to reduce the expenses and fees in your portfolio. And thirdly, we want to increase the performance, increase the rate of return. That's it. If we can't do all three of those, then I'm not going to ask for your business. But if we can do all three, and we have for many clients, then I'm definitely going to ask for your business. So I certainly appreciate your consideration and look forward to being of assistance to those of you who are interested. My number in the office is 770-683-3608. And please know also we have advisors in multiple states. We're in Houston, Texas. We are in Maryland and Washington, D.C. We're here in Georgia. So we are expanding and growing and looking forward to serving your needs. Thank you so much. Take care.